Our next guest says the oil shock from the Iran war is different from previous disruptions. Let's bring in Ruchir Sharma, the chairman of Rockefeller International and the founder and chief investment officer at Breakout Capital, has a new op-ed in the FT today. Ruchir, good to see you again. Thanks for joining us.
Thanks, Carl, for having me back.
We do have the IEA saying that this crisis is worse than 73, 79, and 22 put together. How do you think it's different?
Well, I think it's different from a economic angle, which is that we have discussed it in terms of the oil supply being taken out, all the geopolitical ramifications. But what I argue in my latest op-ed in the FT is that never before has the world entered any sort of a crisis with such high debt and deficit levels. That if you look at the average budget deficit of developed countries around the world, it's close to 4% of GDP. America is, of course, the highest at close to 6%, and that could get up to 7% of GDP this year. And of course, we have average debt to GDP levels, just government debt, of like 100% or more in America and other developed countries. So this is very different. And this has a major implication, which is that unlike in the past, I think that this time governments are going to be quite severely constrained to cushion the economic impact of this oil shock the longer it lasts.
You're right to point out deficit percentages. Yesterday, I think it was PIMCO that did say 7% for 26. And once you started counting in certain ways for, say, student loan provisions, maybe 7.4. That's not the number, certainly, that Secretary Bessent was hoping for.
Yeah, and I think that's why the bond market's reaction this time has been quite different. But if you look at the past few crises, bond yields would typically fall. You'd get a safe haven bid for bonds. But this time, bond yields have risen. And this is not because of inflation expectations going up like in some past oil crises, that long-term inflation expectations remain relatively anchored. This time, it's the term premium which has gone up. And the only way we can explain that, given that this oil shock is a hit to growth, is the fact that there are mounting concerns about the debt and deficit. So this time, the bond market's reaction has been different than past few crises. And also, we seem to be hitting some red lines on the debt and deficit dynamics. I mean, as many people will say, that these fears about the debt and deficits have been around for decades. But what's different this time, apart from the bond market reaction, is that some of the metrics are flashing red. I mean, the fact that the interest expense now on our debt, the amount we spend on that in America is more than our entire defense budget, is something which has been problematic for big powers in the past. So I think that this is something we need to keep an eye on, which is that never before have we entered a economic crisis with such high debt and deficit levels. And that's going to limit the ability of governments to cushion the economic impact. And the longer this lasts, the more problematic that becomes.